SpaceX's $25 billion debt bet. SpaceX just locked in $25 billion of debt. The headline is enormous, but the number investors should focus on is the recurring cost, roughly $1.46 billion of interest every year. Here is what the deal actually does and where the risk sits. The issuance comes in 5 layers. $7 billion due in 2031 at 5.35%, $6 billion due in 2033 at 5.65%, $6 billion due in 2036 at 5.875%, $2.5 billion due in 2046 at 6.6%, and $3.5 billion due in 2056 at 6.65%. Weight those coupons by principal and the blended coupon is 5.855%. That is the cleanest single number for understanding the new bond stack. Multiply that rate by $25 billion and annual cash interest is about $1,464 million. The notes pay interest twice a year. That figure is my calculation from the disclosed principal amounts and coupons. It excludes issuance fees and any other debt. This was not simply $25 billion dropped into a growth account. SpaceX said it would use the proceeds to repay its outstanding bridge loan in full, pay related fees and expenses, and use any remainder for general corporate purposes. That bridge loan matters. SpaceX disclosed a $20 billion unsecured facility entered into in March 2026. Its proceeds repaid specified X and XAI borrowings, including XAI's 12.5% senior secured notes. In effect, part of the new bond stack term finances debt inherited from the expanded corporate structure. The refinancing changes the shape of the risk. A short bridge facility that could mature as early as September 2027 is replaced by fixed-rate maturities stretching from 2031 to 2056. SpaceX trades near-term refinancing pressure for long-term fixed obligations. The new notes are senior unsecured obligations. SpaceX says they rank equally in right of payment with its existing and future unsubordinated debt. Bondholders do not have a specific rocket, satellite fleet, or facility pledged as collateral. The maturity ladder is front-loaded. $19 billion, 76% of the issuance, comes due by 2036. $7 billion is due in 2031, then $6 billion in each of 2033 and 2036. The remaining $6 billion sits far out on the curve, $2.5 billion due in 2046 and $3.5 billion due in 2056. Those longer bonds carry the highest coupons and extend part of today's capital structure for 3 decades. The bull case is straightforward. SpaceX removes a near-term bridge, fixes the borrowing cost, and gains a predictable maturity schedule while it funds rockets, satellites, artificial intelligence infrastructure, and other corporate needs. Long-duration capital can be valuable when the asset build-out is equally long-duration. The bear case is just as clear. Interest is a fixed claim. Launch cadence, subscription growth, margins, and capital spending can move around. The coupon does not. More than $1.4 billion of annual interest raises the cash flow hurdle before shareholders see the upside. And SpaceX remains capital-intensive. Starship development, launch infrastructure, satellite replacement, ground networks, computing, and energy systems all compete for cash. Refinancing improves the calendar, but it does not erase the obligation. Investors should track 4 things: operating cash flow against cash interest, capital spending after interest, net debt as the business scales, and the refinancing plan for the $19 billion due through 2036. Those metrics will show whether this debt is productive leverage or a growing constraint. My takeaway: the bond sale is not automatically bullish or bearish. It is a major capital structure decision. SpaceX exchanged a concentrated near-term bridge for a diversified fixed-rate maturity ladder. but accepted roughly $1.46 billion of annual interest to do it. The investor question is no longer whether SpaceX can raise capital. It clearly can. The question is whether the cash flows produced by this platform compound faster than the fixed claims now attached to it. This video is for information and education, not financial advice. AI-generated concept visuals are labeled and do not depict actual events.